Hello, everyone, and welcome to the Buck Stops here. I'm Catherine Murray. Well, as you know, we've certainly seen weeks and really on a year-to-date basis, very, very volatile markets. So I really wanted to bring you some seasoned and veteran opinions here. Joining us today is Barry Knapp. He is the founder and managing partner of Ironsides Macroeconomics. Barry, great to be with you. And to have your views here for our viewers to really understand what's been going on in the markets. So thanks for being with us.
You're welcome.
Barry, I think too, it's always important for viewers, I really think, to understand your street cred. That's really important. I always believe in terms of who I listen to when I think about overseeing, our family office. I've got my favorite people. For sure, you're one of them, and I think your background is really also important to understand. So maybe just give us a bit of your background in terms of how you've seen the markets and how you've been exposed over all these years. Leeman Brothers.
Sure. I started in Leeman in 1989 in the early days of equity derivatives. After I finished my MBA, I went to work in that equity derivative business where I stayed for 15 years or so, at a point when we were doing ETF-like transactions with macro hedge funds before there were such a thing, and also helping to manage the large structured investor index funds and asset allocators and the like. And it was a fascinating time to be involved in that market. I then moved into a principal trading role at Leeman Brothers in the early 2000s, where I traded a macro book across asset classes and was continuously asked by management through that period, would I consider becoming the equity strategist? I finally agreed to do that right before we went bankrupt in 2008. So when we went bankrupt, I was an equity strategist who hadn't actually ever published a report. But
Wow.
I sat in that seat at Barclays Capital for the better part of the next 6 years as Barclays head U.S. equity strategist, a job I absolutely loved. I then had an opportunity to take what I now consider a sabbatical to the buy side, where I went to BlackRock to help run the unconstrained fundamental fixed income funds. So that was effectively a highly risk-controlled macro hedge fund type strategy. We traded across asset classes, across the world, trying to replicate income-like strategies, but with a wide range of latitude on what we could do. After a couple of years, I found myself missing the equity strategy job and the interaction with, or strategy in general job and interaction with clients. I went to Guggenheim Securities with some former Leeman colleagues, stayed there for 18 months or so before founding Ironsides Macro, which is, a broad macro strategy, independent research shop focused across asset classes, primarily on the U.S., but again, across asset classes on economic trends, but really with the focus on what does it mean for investors. I don't try and focus or forecast GDP per se, but I try and tell you what the trends are and what it means and how you should be implementing those ideas.
Great recap in terms of how you help your clients and what we're going to talk about today, because there's a lot to talk about. And just from kind of a top-down perspective right now, what is your one-liner? I mean, there's a lot to dig into here, but what's the one-liner when we look at all this volatility and uncertainty?
We went from an inflation scare, and we made an argument. I was an early inflation advocate that's what the pandemic was really all about. It was an inflationary shock as opposed to a deflationary shock. That's now morphed into a growth or recession scare that investors are conflating market action with economic activity. And Paul Samuelson famously quipped back in 1966 that we were going to have, or the stock market had predicted 5 of the last 9 recessions. So I was thinking about that a couple of weeks ago, and I realized, well, in my adult life, there's been 5 recessions and four false alarms where the stock market fell 20% or more that were his infamous stock market predicting not a recession. This, I think, is actually number 5. So Samuelson had no idea how prophetic his quip was. So
Right.
that's it in a nutshell.
Got it. Okay, there's a lot to discuss here, a lot to unpack. We're going to take a quick break. We'll be right back with Barry Knapp. We just left off on the topic of the market, which has been under some significant pressure, is a bad predictor of what's really going on in the economy or predicting a recession. So give us your take though first in terms of looking at the economy right now and what you see, because I see economic data that has slowed, but I almost think it's to the point where the US Federal Reserve, and we're kind of hearing that from them this week, that they won't have to be as aggressive in raising rates. It's almost as though we've got maybe a bit of a simmering aspect, and that's why, I pre-taped this on a Friday. We said the market's up yesterday and they're up again today. I mean, it's still early in the day, but we'll see. So what's your take?
The Fed's plan that has been evident since the last FOMC meeting through the series of speeches and the minutes, which really didn't teach us anything new, was always to front load the rate hikes. This is a decision they came to somewhere between the March and the May meetings to try and get the front end rate up to something they consider neutral. So somewhere between 2% and 2.5%, a series of 350 basis point hikes, and then slow the rate hike process as they got to the maximum caps in balance sheet runoff, which will occur in September. And so the market came to grips with that path. And then because inflation has been falling and housing indicators are starting to weaken, the markets decided that they may have, or the markets essentially got ahead of the Fed's plan, and that terminal Fed funds rate priced, you could look at September Fed funds futures, for example, has come down about 40 basis points. But I don't really think there's any change in the Fed's plan. I just think the market got ahead of what the Fed was thinking. And so we've just kind of settled into okay, we get what the Fed's going to do, and it's not so bad sort of idea.
Okay. And so Barry, that's the Fed. And when we bring this home to viewers who, aren't in the weeds like you are and I have been in my past life and still like to be a little bit here. Everybody right now is seeing WTI at $114. People are feeling the inflation effects. They're seeing it in their food and their gas. There's more and more CEOs and corporates talking about food scarcity. Can you just talk a little bit about what people are actually feeling, and then we'll translate it into your outlook?
Sure. I think there's a couple of interesting aspects of the inflationary move. One is if you take a very long-term time horizon and you look at the percentage of consumer spending that goes to food now versus the 70s, it's about 50% is the total disposable income that is committed to food. The same thing is true of energy. So while we've had a shock in those prices have moved up a lot, they're still much lower than they were in the 70s. And so if you combine that with what's going on with income and wages, where the lowest quintile wage earners their wages are going up 3% faster than the highest quintile wage earners. This is the strongest differential we've had since the late 1990s. So you have income going up at the low end. You have a very strong labor market, and you just don't have that same sensitivity to those things that you had back in the 70s. Now, that doesn't make it any better for people having to adjust to it, but it certainly means that they can withstand it far more than they could back in the 70s. What it does mean, though, for sure, is it's a huge political issue for the Democratic Party. And you can point to any of the approval ratings, generic congressional polls, any of those things, and it does portend the consumer confidence indicators. It portends a change in November for sure. That could take you off on a whole other line of discussion in terms of what it means for policies and particular sectors. But it's a political issue as much as anything else at this point.
Interesting. So it's not something that really weighs on your economic or market outlook.
Well, growth was always going to slow in 2022. The question is, will it be slow? And so if you step back and you think about consumer spending in the first 5 years following the global financial crisis, when household debt was at record levels, household net worth had taken a massive hit because of declines in house prices and declines in the stock market. Um, we had consumption in the US average 1.8% per year for the first 5 years of the recovery. That's against a post World War II average of 3.4. In the back half of the 2010s, when the deleveraging slowed and household net worth had stabilized and begun to grow again, that rate of consumption or trend consumption increased to 3%.
Barry, you just mentioned that consumption was at 3%. What's the significance in terms of where we were historically?
Well, where I was going with this was people tend to have recency bias. So there's this concern with retailer earnings, for example, this week that consumption could slow decidedly. We could have a recession. And what I'm trying to remind the viewers of is that this slow consumer spending trend that we have after the global financial crisis was because debt was so high for the household sector and household balance sheets were so impaired. This go around, the opposite is true. Debt is at the lowest levels it's been since the late 90s. Financial obligations ratios, the percent of disposable income that goes to interest payments, is at historic lows, and household balance sheets are quite strong. So if you think then what's likely to be the trend to consumer spending in the 2020s, and you further consider demographics, and I know people are fond of saying, well, we have aging populations and aging population in the US, which means consumption is going to slow. It's actually not so simple as all that. In the 2010s, you had baby boomers preparing for retirement. That's a very big demographic in the US. There's 77 million of them. This go around, we have Gen Zers preparing for retirement. There's only 63 million of them. And millennials, which is our biggest age cohort, 83 million of those, are actually in peak consumption years and forming households. So we have a very different demographic backdrop for consumption that would imply trend might even be stronger than 3%. So while I say growth is slowing, but not going to be slow, that's integral to my view. Once all this noise switching from service spending, good spending to service spending settles out and we figure out where true growth is going to be, I think it's going to be stronger than last cycle, perhaps quite a bit stronger than last cycle. So inflation will be higher, nominal growth will be higher, but real growth will be higher as well.
Interesting. And I want our viewers to understand, I think that's one of the more bullish views out there these days. Would you agree?
I do. I think that there's a lot of misunderstandings around how all these business cycles work and how demographics work. I think people just extrapolate straight out. And nominal growth matters a lot. So the period that I've drawn the analog to that I think is most interesting and most informative is what happened in the 1960s. In so many ways, the 50s were like the 2010s. We were coming off the Great Depression. We had very tight bank regulatory policy. We had very uneven growth, very weak capital investment. All those things were similar to the 2010s. But in the 60s, we started to have much stronger nominal growth. Inflation started to grow, and go up decidedly. It was a reflationary period, but that actually meant stronger earnings growth, stronger nominal GDP, and a period that was not so good for the bond market, but pretty good for the stock market for a good deal of time until ultimately we got to the 70s. Now, some people have skipped straight to the 70s and think that's where we are. I do not. I think that we are going to be in a higher inflation environment, but not a rapid inflation environment once all of these cross currents start to settle down.
Interesting. Yeah, everyone's jumped to the 70s. Some have moved to the 90s, but I haven't heard the 60s, so that's interesting. One piece of information I wanted you to address, though. The earnings and the stock reaction to Walmart and Target the other week were were something we've not seen. Well, I don't think the stock price performance for one of them was that bad since 1987. I think it was Walmart. How do you explain that as it relates to the consumer? Just we only got about a minute in this segment.
Sure. The most important number that we've gotten in the last month was the March imports number. And seems like a little bit of an obscure number, but March imports increased 26.4% from February. That's the single biggest increase in imports that I can find going back to the mid 60s. And what that represents is supply chains clearing. So we now know where all those imports went. They went onto Walmart and Target shelves. That, of course, means they have excess inventories. They're going to have to cut price. We've seen prices start to fall sharply. Goods prices start to fall sharply. Even this morning's core PCED number reflected that. So this was actually more of a price effect than a demand effect. Another way of saying it is the supply curve shifted more than the demand curve did. It caused a big margin hit for those stocks. But I think the macro interpretation of that was an overreaction.
Okay, we'll leave it there. We'll pick it up on the other side of the break. We've kind of set the stage in terms of some of the big macro factors affecting the market, affecting the economy. Where does this lead you in terms of how investors and how our viewers should be thinking about the market, their portfolios, and perhaps what to do next?
So more broadly, when you think about these various business cycles, trace them all the way back to World War II, you hit these inflection points where the economy achieves what Muhammad al-Arian would call escape velocity. And it's a point where the Fed decides, okay, we no longer need to provide accommodative policy. We're going to start normalizing that policy. Those typically, in every business cycle until the last cycle, those caused one equity market correction that worked out to be one of the best entry points for investors other than buying during the depths of the recession-related stock market decline. By the way, that's an important note, is the median decline for stock markets in the U.S. associated with a recession is 24%. We went down 20 in the latest sell-off that we've had. But these Fed policy corrections have turned out to be really good entry points. 2010 during the flash crash, 2011 is another good example where the Fed was trying to normalize policy. The market sold off. Investors got a little carried away with what Fed policy was going to do to the economy. It created a growth scare, and that was a good time to put money to work. So that's what this one is. This was our forecast for at the beginning of the year, or for our 2022 forecast, was the first half of the year was going to be very difficult as we reversed the liquidity provided by the Fed, the liquidity provided by the Treasury, and the liquidity provided by Congress from the overly aggressive stimulus programs of last year. So we've now had that. I expected it to be 12. Obviously, it was 12%. That is, it's been bigger than that. But the timing was always going to be a difficult first half. And then as we got closer to the back half of the year, the elections, the markets would recover more than fully, and we'd move on with the rest of the business cycle. That's the point we're at. Now, concurrent with that is when you get those Fed policy corrections, that generally signals a transformation to mid-cycle activity. And what I mean by that is during the early stages of the cycle, you have pretty standard patterns in terms of what works from a sector perspective. Small caps rally, consumer discretionary rallies, financials rally, tech generally rallies. But when you get past that Fed policy correction, you start to settle into what are the trends that are going to differentiate this cycle from the last one. And so with respect to that, if you think about tech, which is on everyone's mind, in the 90s, tech obviously was the driver of the entire business cycle. In the 2000s, tech lagged, and it was at best a market performer, and you had other sectors take hold, energy and financials in that case. In the 2010s, again, tech led. This cycle, I think those benefits of the build out of the cloud, of digitization, are going to start to accrue to the users of that technology. So the financial sector, the healthcare sector, the industrial sector, as we rebuild our manufacturing base and restructure supply chains. So I think that's what's going to be evident in the coming months, is that this is going to be more of a reflationary theme. The best performing sectors will be more cyclically oriented sectors, value over growth, which I don't generally talk about too much because I prefer talking about the sectors. But this, I think, is going to be evident in the coming months that the business cycle is not over. We have several more years to go at a minimum, and but it is going to be different than last cycle. It's not going to be tech driving everything forward.
Right. That these companies, what you're essentially saying is these companies are benefiting from all the money that's gone into technology, and that they'll benefit on their margins and therefore their multiple expansion, presumably.
Yeah, another way to illustrate this point, actually, that I think might be helpful to people is if you think about the building out of the infrastructure of the internet, fiber optics capacity, for example, in the 90s, and then in the early 2000s, those WorldCom and Global Crossing and all went bankrupt. But out of that excess capacity came the streaming business, right, which was a fantastic success over that next 2 decades or so. Well, in this case,
Yeah.
you're allowing healthcare to be delivered remotely. You're allowing the Internet of Things to develop and manufacturing to become much more automated, such that it doesn't all need to reside in China. Financial
Right.
sectors and services to be distributed that way. So it's just going to be a different cycle.
All right, Barry, we got to leave it there. Great to see you. Thank you so much for your views and your experience. Thank you.